The profit and loss account is one of three core financial reports. Understanding it is key to understanding the historical performance and future viability of your business. But it needs to be used in context, as it does not provide a complete picture of the financial health of a company. It answers the key question: how much profit did you make? Or how much profit will you make when a budget or forecast profit and loss account is prepared? In isolation, it does not tell you if you are generating or consuming cash, or how well your assets and working capital are being utilised. To get the visibility of these very important business aspects, we also need to see the balance sheet and the cash flow. The profit and loss account is sometimes referred to as the income statement. The profit and loss account is one of the three core financial statements, the others being the balance sheet and the cash flow statement. The P&L reports on financial performance over a period of time, i.e. between a start date and an end date. This could be historical, i.e. past performance, or in the future, i.e. a budget or forecast of what will happen. When payments or receipts of money happen that do not relate to the profit and loss period, adjustments are made. A profit and loss account forms part of your statutory accounts. These are prepared annually to accounting standards, usually by an accounting firm. They are submitted in various forms to Companies House and HMRC. They are prepared so that accounts can be consistently understood, as the treatment of all items should be consistent across companies. It is a legal requirement to file these on time. Depending on the size of the company and type of submission, they are available to the public, so they could be used by creditors, banks or suppliers, and investors, but they have little or no value from a business management perspective. Management accounts are financial statements prepared to satisfy your requirements. They are there to help you manage your business. Business management decide how they want to see the accounts, the presentation, and at what level of detail. Historical accounts should be produced at least monthly and within a few days of the end of the month. Your accounting systems and processes should be set up to enable this. If your management accounts are not available for weeks after the end of the accounting period, their value for financially managing and controlling your business is reduced. There may be other financial management information that you want to see more frequently, weekly, daily, or more frequently than that. This is a typical profit and loss account layout. It relates to the month of April. It shows sales in the month of April, regardless of whether the money related to those sales has been received or not. More on this later. It then deducts all costs associated with the sales, cost of goods sold, and costs related to running the business during April. In this case, sales and marketing and general and admin, to arrive at a profit figure. You may decide that you want to see the costs split out in more detail, e.g. by functional area, sales, marketing, operations, IT, finance, etc., depending on how your organisation is organised and how responsibilities are devolved. This profit figure is often referred to as the operating profit. There are some other widely used profit terms which we will cover shortly. Further deductions could be made after the operating profit for interest payable or receivable or taxation related to that period. Again, we'll look at this later. We will now start to add further information to make the profit and loss account more useful. At the top left, we show that the accounts have been prepared in sterling and are rounded to the nearest £1,000. This is important if your business trades in more than one currency. We have added a percentage that shows cost as a percentage of sales and the figures that we budgeted for April. In this case, sales came in exactly as budgeted, but there is a difference in the cost of sales which results in an increase in gross margin from 55% to 60%. We should be finding out what caused this difference or variance. See sales and cost of sales variance analysis. For your management accounts, you may want to see the costs split out in more detail. That's your decision. We have now added a lot more columns to the profit and loss account. Not only do we have a comparison to the budget for April, we now have year-to-date actual figures compared with the year-to-date budget and prior year-to-date. You should decide if these comparisons are useful to you or to any other investors or stakeholders. If you don't have prior year numbers, obviously you leave them out. If you do have prior year numbers, but the business has changed substantially, they may not be relevant. I would argue that you should always have a budget and/or forecast. The stability and predictability of your business and how you incentivize your staff will influence how often you update your financial plans and how you use them. In the profit and loss account shown here, there is a deterioration in the gross margin from prior year to budget to year-to-date actual. We need to understand this. We'll cover more of this in sales and gross margin variance analysis. It may be appropriate for you to produce multiple profit and loss accounts that sum to a total profit and loss account for your business. There are two reasons why you may decide to produce multiple P&L accounts. One, responsibility, for example geography or area, and two, by product or service. Is a particular part of the business performing in line with financial plans, and hence is any intervention required? Is a particular product generating the profit levels planned? Does this product have more potential, or is its viability in question? These may be short versions of the P&L, showing the contribution from different parts of the business, but only showing those costs that are directly related to the responsibility area or product. Beware of business divisions that buy and sell from each other. These intercompany sales will need to be eliminated. There are a couple of terms that you may come across, particularly when talking to experienced investors: EBIT and EBITDA. EBIT stands for earnings before interest and tax. EBITDA stands for earnings before interest, tax, depreciation and amortization. Earnings is just another word for profit. They are used for comparing the results of different businesses. The purpose of these measures is to remove the business costs that don't affect the underlying operational performance of the business. For example, take two companies that are in the same business sector, but one of them has large lending from the bank and hence a high interest charge, whereas the other is capitalized by shareholders and pays no interest. Whilst the overall profitability of the business is affected by the interest charge, the underlying operational profitability of the business is not affected. These figures are also often expressed as a percentage of sales.